Continuing with our 2014 Outlook series, joining me today will be Peter Hugg on this edition for Pete's sake. We're going to talk about the taper, what happened there, and what might happen moving forward with gold prices in 2014. Stay tuned. Santa Pete, looking good. Thanks for joining me today.
You're welcome, Alex.
All right, Pete, so of course, let's start off with Ben Bernanke and the taper. Sort of a mini taper there. The market reacted kind of strangely, didn't really know what to do at first, then obviously went down sharply. What's your take on what happened from Wednesday until now with the taper and the price of gold?
Yeah, well, I have to admit I was wrong. I didn't think that, well, I was wrong and I was right. I mean, I didn't think tapering would occur until 2014, and technically I was right because it doesn't start until January. But I was surprised that Bernanke took the chance and the Fed took the chance and announced the tapering, ahead of Christmas. I thought it was a dangerous maneuver because of what it could have done to the equity markets. But, I got to give credit where credit is due. They did a brilliant job in how they formatted the announcement. They said they're going to, reduce taper by 10 billion. Beginning in January, I think that's it, and then we'll see, and then they're going to watch their economic data. But he cushioned the blow by indicating at exactly the same time that he was going to keep the Fed funds rate pretty much at zero, well past 2014, and even past his basis of 6.5% unemployment rate. So, he's basically given the markets a green light. Look, we want to taper. We want to start to get back to normalization. But at the same time, look, the money's going to keep flowing. I mean, $75 billion a month in bond purchases is still adding massive liquidity to the market. We'll keep interest rates at zero, not to worry. And, the equity markets reacted extremely well, up 300 points.
Another question mark for gold and the economy was, of course, the budget deal in Congress. Seems like it's going to go through, so no deadline there. Now, what does this mean? I mean, now that the taper is sort of coming in, you have the budget deal that seems to be solved. What do we look forward to now with the economy and gold prices in 2014? Well,
I don't think a lot has changed here. I'm certainly not recommending that anybody liquidate their insurance positions in metals. I mean, 75 billion of bond purchases a month and a zero interest rate policy throughout 2014 augurs in my mind, a potential issue with inflation, whether that'll begin, first quarter, second, third quarter of next year. But I think it's in the cards. So I certainly would want to maintain a core position in a hard asset, to protect against potential geopolitical events and just headline events. That would protect your portfolio, in 2014. Now, as a trader, we've been very, negative is the wrong word, but I've been very cautious this market ever since it breached 1425 last year. And the technicals and the trend have been negative. But that doesn't mean that as a trader, there weren't opportunities to go long this market last year. There were plenty of opportunities. I mentioned in my commentary this morning that, the last time gold was here at, the 1180-ish range, we recommended strongly that this market should be bought. And, we had a rally all the way back to 1400. So there's going to be massive trading opportunities in 2014. Will gold drop to 500? No, I don't think so. But I mean, could gold go to $1,000? Yeah, I think it's possible.
Right, Peter, I wanted to touch on that. In your commentary this morning, you said that you can be a bear and a bull within a very short period of time, sometimes within a day, within a week. Can you elaborate on that? I'm sure some of our readers and viewers are probably scratching their head a little bit to that comment.
As a trader, you've got to divorce yourself totally from that emotion. And you look at fundamentals, you look at technicals. And I could just as easily be long this market at 8:30 in the morning when it opens, and at 10 o'clock be a raging bear because something has changed. But if you're not that nimble and flexible as a trader, you're going to get hammered in this market. You're not a trader then. You're basically a buy and hold investor. So that's why I'm trying to make the differentiation between being a trader and someone that is holding precious metals as a percentage of their portfolio for protection against whatever risks you think are coming around the corner.
Sounds good, Pete. Let's wrap up with your trading range for gold in the coming holiday week.
You know, I mean, there's a number of elements that could still come to play between now and the end of the year. You know, there's still trading days left for people that have losses in their precious metals position, that may be tempted to sell their metals to lock in capital losses against potential capital gains in their equity portfolio. So some of that may come to the market. I mean, Europe takes Christmas extremely seriously. So, you know, by midday Monday, this market will literally be shut from a European perspective. So you have very, very thin markets. So, you know, we could easily see gold at 12.25, and on the downside, I think 1180 will hold, but it's possible we could test it. But I think that might be the range between now and the end of the year, because I don't see any other news, and I think most of the action is behind us.
All right, Peter. Well, if I don't see you before the holiday season kicks off, all the best. Happy holidays to you.
Happy holidays to you and to all the listeners and viewers of Kitco, and hopefully 2014 will be very successful for everyone.
And thank you for watching this edition of For Pete's Sake. Remember, we still have our Outlook series going on for 2014 on our homepage. And if you have any comments or questions, don't hesitate to send them to newsfeedback@kitco.com, or you can find me on Twitter @Alex_Letourneau. Have a good one.